Okay, I repeat, yeah, about chapter 19, partnership. This is another type of business which is different from our previous type of business, which is sole trader. Up until chapter 17, you have learned only one type of business, which is sole trader, yeah. But now we will study about a partnership which has different ownership. Okay, now in this chapter you will study about advantages and disadvantages of forming a partnership, and then you also will learn the importance and contents of a partnership agreement, since in the partnership the ownership is including 2 or more people, maximum 20. So definitely in a partnership, they need partnership agreement. Yeah. So number 3, the purpose of appropriation account. This is just like a statement, new statement. Yeah. Additional to income statement. So you have learned income statement, you have learned SOFP, and appropriation account is an extra statement after you create income statement. Yeah. And then number 4, you will learn how to prepare income statement, and then appropriation accounts, and then statement of financial position. Yeah. In this chapter, you must already understand and be able to do income statement without having to look on notes, and then statement of financial position also. Yeah, so you have to be good at income statement and statement of financial position. And then number 5, how to record interest on partner's loan, how to record interest on capital, how to record interest on drawings, how to record partners' salaries, and the divisions of the balance of profit or loss of the partnership. And then you will learn also on the making adjustment to the financial statement. I believe we have learned all of these. Yeah, we have learned depreciation, we have learned accrued and prepaid, we have learned provision for doubtful debts. Yeah, it will be included here. And then explain the uses of and differences between capital and current accounts. We will learn about this. And then you will learn, last one, you will learn partners capital account and current account, yeah, in the ledger. Okay, as part of statement of financial position. Okay, so that's basically wrapping up what we will learn on this chapter. Okay, let's continue the theory. Okay, in terms of chapter 19, partnership, the theory will be there. So it is not only calculation, but the theory about partnership sometimes occur, yeah, around maybe 20%. Okay, and it also include analytical thinking. Yeah, for example, why does a sole trader wanted to change the ownership into partnership? So you have to be able to explain logically. Yeah. So this is the advantages and disadvantages of partnership. Let's see the advantages first. Yeah. Partnerships are simple and cheap to set up. It is easier to raise capital for the business as each partner will contribute finance. Okay. Number 3, partners may have different skills which work well together and which will enable the business to benefit. Partners also contribute to the pool of knowledge and contacts that a business can use. Yeah. For this one is very, very useful in terms of partnership. For example, Nicole, Fisha, and then Kenya, yeah, decides to make a partnership. Okay, Why you three joined together? Because in terms of, let's say in terms of managing the business, Kenya have the skill. Okay, managing the business. In terms of accounting, Fisher have the skill. Okay, and in terms of marketing business, Nicole has the skill. So they seek the strength point on each other, yeah, and then you join together and make a partnership. Okay, instead of hiring a new employee to start a business, why don't you run by yourself and you have all the skills? Yeah, so this is the advantages of making a partnerships. Okay, next, partners with their own area of expertise will make the business more productive because you own it. Since you own it, you will be more careful and you will be more thorough in terms of running the business, yeah, other than the others. And then, for example, let's say a firm of lawyers could have a partner who specializes in family law and another in business law. This means that the business can have a wider customer base. Yeah. Okay. In terms of partnership, in the real life, I suggest you to avoid family partnership. Yeah. From the history or experience, usually family business, if it is not well managed, it tends to collapse. Yeah, so please be careful in terms of making a partnership or making a business based on family. Yeah, there's a theory on that also. Okay, but we're not going to talk about that more. Yeah, but we are talking about partnership more. Yeah. Next, partnerships can provide more creative ideas that contribute to good decisions. More people, more creative, yeah. Responsibilities and risks are shared between the partners, and any losses are shared between the partners. So if you are sole trader, 100% loss will be 100% of the owners, yeah. But for partnership, the losses can be shared between partners, not 100% charged to one partner only. Yeah. For the disadvantages, of course, the profit must now be shared. It's no longer 100%. Disagreement can occur. Yeah. Disagreements can occur, of course. You are dealing with people. Yeah. And more than one people may occurring disagreements. Okay. Next, decisions are jointly made. Therefore, they might take longer. And then number 4, all partners are liable for errors made by one of the partners on behalf of the partnership. So let's say, speaking of the partnership made by Kenya, Fisher, and Nicole, let's say Nicole have made bad decision. Yeah, even though it is her decision, but all partners will get the effect of it. Yeah, they also liable for the errors. Yeah. Next, partners or ordinary partnerships have unlimited liability. This is the same like sole trader. Yeah, it means partnership is risky. If you still remember what is unlimited liability, it means that personal assets of the business, personal assets of the owner and the business are not separated yet. If the business falls or bankrupt or liquefied, so personal assets of the owner might be taken to pay the debts. So this is the dangerous of partnership. Okay, it has unlimited liability. Okay. Next, since we are dealing with peoples in one business, partnership agreement is needed. Okay, partnership agreement is not a legal requirement. It is not a must, yeah, but it should be considered essential or important because these agreements between partners is one of the major reasons why partnerships may fail. Yeah, once again, partnership agreement is not a must in a partnership business, but it should be considered essential or it is suggested, yeah, to avoid disagreements in the business. Okay, now in the partnership agreement, there are clauses, yeah, clauses in the partnership agreement that you must know. These are the clauses, yeah. The first one is percentage of ownership. Okay, since one business is held by few people, so it is very important to know how much capital is contributed by each partner. Is it 50-50? Is it equally? Yeah. Is it based on portion? For example, in Kenya's and Nicole's and Fisher's business, they agree to contribute equally. Yeah, it means 33.33%. Yeah, but there's a possibility that Kenya is contribute more than the two others. Yeah, so it will create a ratio of 2 compared to 1 compared to 1. Yeah, for example, the business needs 100%. 100,000. Okay, now $100,000, yeah, given by Kenya 50K, Fisher 25K, and Nicole 25K. Yeah, this will brings the ratio of 2 compared to 1 compared to 1. Yeah, 2 to 1 to 1. So this is called ratio. It is really important to know the percentage of ownership because it also indicates how important your voice is inside the business. Yeah, it means Kenya's voice is more, what is it called, is above Nicole and Fisher because he has 50% of the company ownership. Yeah, you understand what I mean? Yeah, so the percentage of ownership is and must be included in the partnership agreement. Yeah, so it is not necessarily to have equal capital. It can, but it depends on the agreements. Yeah, now next, distributions of profits and losses. Partners may share profit and losses in portion or proportions to the capital they have contributed. For example, in this case, 2 to 1 to 1. It means whenever there's a profit, Kenya will get 2 out of 4 portion. Nicole will get 1 out of 4 portion. Yeah, and Fisher also get 1 out of 4. Yeah, how do I know that? Because the portion here is 2 compared to 1 compared to 1. If I total them, it is 100%. Yeah, but in terms of value, it is 4. 2 plus 1 plus 1 is 4. Yeah, so Kenya will get 2 over 4, which is half of the profit. Meanwhile, Nicole will get 1/4 or 1 over 4 and Fisher 1 over 4. Yeah, so they can use the portion from the capital they have contributed. The partnership can also have an equal way of distributions, profit and losses, even though they don't have the same capital contributed. Yeah. And then, or in any other way they choose. The profit or loss sharing ratio is stated in the agreement. So, number 1, percentage of ownership. Number 2, how the profit and losses will be shared among partners. Number 3, drawings. Drawing is really dangerous when there is no limit. Okay, if you are in sole trader, you own your own business, so no one is controlling you. But when it comes to partnership, you have to have this agreement. Okay, how much the maximum limits that may be placed on partners' drawings, so they do not affect the partnership liquidity or capital base. Yeah, because too much drawings will disturb. Yeah, will disturb operational. Yeah, so it's really important to set limits on the drawings. Yeah. Next, interest on partners' capital. So there is capital contributed and there is also interest on capital. Okay, what is actually interest on partners' capital? The partnership agreement states the rate of interest on capital earned. This is a way of rewarding partners for investing in partnership. So interest on partners' capital is actually a return, yeah, percentage of return given from partnership to partners. Okay, let's say in a ratio of 2 to 1 to 1, back to this example, yeah. The partnership interest on capital is, let's say, 5%. So Kenya will get 5% out of 50,000 at the end of the year. Nicole will get 25% times 5% as her profit. And Nicole is also receiving 5% out of 25,000. Yeah, it is reward for the partners. Yeah, given by partnership. Okay, because partners have invest money in the business. Yeah. Next, if we have interest on capital, we also have interest on partners' loan. Now, the partnership agreement states the rate of interest on loan from partners. Sometimes partnership took loans from partners instead of bank. Let's say after 5 years, the partnerships need more money. Yeah, because you know the regulation and the process of borrowing money in the bank is quite long. So instead of borrowing from the bank, the partnership borrowing money from Fisher, let's say. Yeah, and it is easy. Why? Because Fisher is one of the owner. Yeah, it's just like as simple as that, given the money and with an agreement that Fisher will get interest from the partnership. Yeah? So that is actually interest on partners' loan. It must also stated in the partnership agreement. Interest on drawings. The partnership agreement states the rate of interest on drawings, and this is the way to discourage. Yeah. Interest on capital is to reward partners, but interest on drawings is to discourage partners from making cash drawings. Yeah, if the partners took money for drawings from the business will charge interest to partners. Yeah, it's like an expense for partners, but it's like an income for partnership. Yeah. The difference between interest on capital and drawings, interest on capital is like an income for partners, but it's like an expense for partnership. Clear enough? Am I confusing? Oh yeah, clear, yeah, okay. Next, partners' salary. Now, salary is a form of reward to partners who also work longer in the business, yeah, or who take on more responsibilities. Now, the amount of salary must be stated in the agreement. For example, Kenya, still Kenya, Fisher, and Nicole, yeah. After 5 years, Kenya said, I don't want to run my business again. I just want to be the owner of the business. Yeah. But Fisher and Nicole wants to spend more time longer in the business. They want to be also a workers inside the business. Yeah. So it means Nicole has more responsibility as well as Fisher. And their responsibility must be given with salary because they are working inside the business. Yeah. Owner / workers as well. Okay. Now they must be given with salaries, and the salaries to partners must be stated in the partnership agreement to avoid disagreements in the future. Yeah. Because maybe salary, Nicole's salary and Fisher's salary might be different. So it has to be set in the agreement on how much should they receive the salary. Okay. So those are the clauses of the partnership agreement that you must understand, because this will always occur in the partnership agreement. Not all, but the one, there are 4 that usually appear. Yeah. Percentage of ownership, they usually appear because that is important. Yeah. Distributions of profits and losses. This is really also almost every partnership agreement has these 2. And then interest on capital and interest on drawings. Those 4 are partnership clauses in the partnership agreement that I saw always appear in every cases. Yeah, in every case. So drawings limits, interest on partner's loan, and salary, not always there. Yeah, but these 4 that I just stated just now, ownership, percentage, distribution, interest on capital, and interest on drawings, usually there. Yeah. Another one that usually comes, but not always, is partner's salary. Yeah, this one rarely appear, and not rarely. I would say not always, but often. Yeah, not always, but often. Yeah. Okay. Next, yeah. Do you have any questions so far? Okay, next. Now let's move on to the accounting part. Okay, enough with the theory. So we will continue to the accounting part. The first statement that you need to learn is income statement of the partnership. Now, income statement of the partnership is exactly the same with the income statement of sole trader. So you don't have to learn a new format, yeah? Everything is the same. Clear, yeah? Everything is the same. You can look on the income statement of sole trader, which is in chapter 9. Okay, so income statement, solve. Now, after income statement, instead of continuing to SOFP or statement of financial position, we must prepare appropriation account first. What is actually appropriation? This is appropriation. This is about how the profit be distributed among partners. Yeah. So after we have net profit from the income statement, we will distribute the profit to the partners. Okay. And this is how we distribute the profit. Since profit and loss appropriation account is the continuations of income statement, and the result of income statement is net profit. Yeah. So the template will be like this. The first is the company's name. The second one is the name of the statement, which is income statement, appropriation account for the year ended, blah, blah, blah. And then it will be started with net profit, because in the income statement, last result is net profit or loss. Yeah. So we will start with net profit over here. And then you will add with interest on drawings, if any. Yeah. Interest on drawings, if any, between partner A and partner B, you should add them. And then this interest on drawing will be added to net profit. Why it is added? Because interest on drawings, just like I said before, interest on drawings is like an income to the partnership, but it is like an expense to partners. Yeah, since we are in point of view of partnership, so we will add interest on drawings. Yeah, because it will increasing the net profit. After you add with interest on drawings, next is interest on capital. Interest on capital is reward given by partnership to partners. That will be taken from the profit. So that is why it is negative. Yeah. So interest on capital between partner A and partner B given here. Total, and then put bracket because this will be deducting the total profit that you have. After that, if there is salaries, salaries will also decreasing net profit. So salaries here, put bracket also, and then put the result. Total net profit added with drawings minus with interest on capital minus with salaries. Then it will become profit to be shared. Okay. After you have profit to be shared, then you will share the profit. It's called profit shares, yeah, between partner A and partner B. How you share this profit is depending on the distributions of profit and losses stated in the partnership agreement. Is it equally? Is it based on capital contributed or based on ratio? Yeah. After that, after you calculate that, then the profit to be shared has entirely been distributed to the partners. That make a result of the net profit that net profit remaining is 0. It already been shared. Clear, yeah? So appropriation account result must be 0 at the end. It means all profit has already been distributed. Okay. Up until this point, do you have any question? No question? Clear, yeah? Next. After you have income statement appropriation account, then I will continue to current and capital accounts of partnership. Now, current and capital account of partnerships are basically capital account. So this is capital account, yeah. If I skip this two, you will see statement of financial position, this one, okay, that you have known for this long, yeah. Statement of financial positions of partnership are the same like others, except this part. Okay, so since the ownership of this business is different from sole trader, so the only part that is different is the capital part. Yeah, non-current assets, current assets, non-current liabilities, and current liabilities are the same. Okay, now look at the capital part over here. Capital part divided into capital accounts and current accounts. And you have to separate between partner A and partner B. Okay, put the total, and then this is total capital and current account, just like this. Now, how to know capital accounts and current accounts is based on this T account. Now, why does capital account is separated between capital and current account? Yeah, this is the reason. Remember that we have a clause of interest on capital. Interest on capital here is the reward given to partners from partnership from the investment made by the partners to the business. Yeah, so it is really important to have a fixed capital account that stated how much money that the partners invest in the business. Yeah, now in usual manners, this capital will always change whenever there is drawings and shares of profit. Yeah, it always changes because every year there must be a profit and also there must be drawings. Yeah, now if we put all of these changes usually happens yearly inside the capital account, it is impossible for us to know how much the original amount of investment given by the partners to the partnership, because it already been affected by profit shares and drawings yearly. So it is no longer purely how much the investment made to the business. Yeah, so that is why in partnership, current account is separated from capital account. And the capital account here is only for how much money invest in the business. Yeah, how much the money invest in the business. Yeah, there will be no affection from drawings and profits. Yeah, this different from capital account in sole trader, where drawings and profit inside the capital account, but for partnership cannot. Yeah, because when you put them here, you cannot calculate interest on capital anymore because you don't have the amount of capital invested purely. Yeah, now so to avoid that, we have current account, and this current account is recording changes made every year because of drawings, profit or loss, interest on drawings, interest on capital, or salaries for partners. The point is all that happens during the year or repeatedly happens every year. That is not related to the capital investment. Yeah, so inside current account, I already gave you this templates, yeah, which is the very complete template. So the current account here has balances in credit side because it is normally part of capital. Yeah, so it has balance in the credit side. Okay, but there is also a possibility that you will have balance PD in the debit side if the partners took too much drawings. Yeah, if the partners took too much drawings and then the business also have loss, it means what they get is lower than what they have to pay. Yeah, that is why current account might have a debit balance. And this is really rare, but it might happen. Once again, it is not always happen, but it might happen. Yeah, the normal balance is in credit side. So current account is basically partners account. Okay, so capital current account balance BD in credit side and then add it with interest on capital. Remember, interest on capital is reward, yeah, for partners. That is why interest on capital will increasing current account, because this is partners account, yeah, not partnership. Yeah, it's not like here partnership where it is deducting profit, but for current account it is adding the account because it is for partners. Salaries for partners also in the credit side because it will adding the current account. Profit shares also adding, yeah. Interest on loan to partner is also adding only if it is accrued. Once again, only if it is accrued. If there is an interest on loan and the interest on loan to partners is accrued, you must place it here. If it is not stated that it is accrued, do not place it in the current account. Clear, yeah? Next, drawings will be in the debit side because it will deducting partner's account. Lost shares also in the debit side. And interest on drawings also in the debit side. Okay, after that, balance CD normal will be in the debit side and balance CD of abnormal balance will be in the credit side. And then carry it down to the next counting period, and then that's it. Now, the one that you will take for the SOFP is the balance here or here, yeah? It depends. If it is in the debit side, it means you have negative current account. If you have balance in credit side, you have positive current account. Next, any questions so far? No? No, yeah? Okay. Next, template for capital account. Now, not like current account. Capital account, simple. You have balance BD. You have additional capital, which means this is indicates that there is another investment inside the business, yeah, from the partnership. From the partners to the partnerships. Okay, so calculate balance CD and then that's it. Next, I want to talk about transfer current account balance to capital account. Now, transferring current account balance to capital account can be in debit or credit. It depends. For example, yeah, this balance of balance BD in the credit side will be transferred to capital account. So it means from current account, it will goes to credit side of the capital, transfer. It's called transfer, yeah? Okay, so if in the current account, it is in the credit side, it will shown in the capital account in the credit side. You move, it's like wallet, yeah? It's like a wallet. A wallet, let's say you have $100,000 in balance BD of current account, wallet number 1. You move 100,000 to wallet number 2. So it means this will decrease by 100,000 and this will increase by 100,000. So you will see current account here, 100,000 added, yeah? So it is called transferring, yeah? But if you have debit balance of current account, when you transfer to capital account, it will also shown in the debit side, yeah? Balance of minus, if it is transferred to capital account, it will minusing capital account. because basically this current account is part of capital. Ya. Jadi so current account considered as additional capital. Jerry Joe question, ya. Basically current account is not additional capital, ya. Additional capital means new investment made to the business. Current account is the changes made every year, accumulated. Okay, so there is sometimes if the partners have negative balance on current account, it means that partners have debts to partnership. I repeat, yeah. Sometimes if partners have negative balance in the current account, yeah, it means that the partners have debts to partnership. Okay, now sometimes partners don't want to have debts to partnership. And then partners can also say it like this: I don't want to have debts. I have big capital, but I know that I took more drawings than the others that will make my current account have negative balance. Why not? Yeah, this is I say to my partnership. Yeah, why not? I move my debts from my current account to my capital account. Just take the money from my capital account and erase my debts. So this is what happened when the owner transferring current account to capital account. Either they are paying their debts because they took too much drawings, yeah, or I would say I want to add my ownership to the partnership, but I don't want to add extra money, physical money, yeah. But I have current accounts already. Total of my rewards that the partnership haven't paid me yet. Okay, so why not part of my current account given to my capital account, yeah, and then adding my portion of ownership to the partnership. Yeah, so it means that current account can be used to add capital or to deduct capital. And what Jerry said here is the current account considered as additional capital. It is not always, yeah, Jerry, but it can be. Depends on balance of your current account. If the balance on your current account is negative, it means it will not act as additional capital, but it will act as payment to partners' debts. Make sense, yeah? If current account positive, yeah, and then it is transferred to capital account, yes, it can be considered as additional capital. Am I answering your question, Jerry? Okay. Everyone clear, yeah? So what Jerry asked is current account considered as additional capital? And the answer is the one that I just said. Yeah, it depends on balance on the current account. Excuse me. Okay, continue. So transferring current account to capital account may result your current account your capital account have an additional entries in the debit or credit. Yeah, it depends on here. It depends on your balance of current account. Yeah, Okay, continue. Statement of financial position of partnership. Okay, after you have a balance of capital account as well as current account, these two balances will be taken and will be placed here. Capital account, current accounts for partner A, for partner B. Yeah, and then you put a total, and then the rest are the same. Yeah, total assets must be equal with total capital and liabilities. Okay, now next, last one. Other method to show capital and current account in SOFP. This way is where the current account is shown as full details in the SOFP. Now, I have seen several questions in IGCSE that requires you to do current account, not in the form of the account, but they want you to do the calculation of current account inside SOFP. Once again, inside SOFP. So if you see over here, capital part, capital account is here. And then when you do current accounts, yeah, you did not put it as simple as this, but you will break down this row into calculations of the account here. Yeah, it will look like this. Okay, this is part of capital only. First is capital account. Aduh, maaf ya, anak Miss Director ya. So this is the first one, capital account here. And then for current account, it will break down like that. Plus with opening balance, plus with interest on capital, plus partners' salaries, plus profit shares, plus accrued interest on loan to partners. All of these plus are those items in the credit side, if you notice. Yeah? And then all the credit side will be deducted. Okay, so it will look like this. Minus with partners' drawings, interest on drawings, and lost shares. Okay, I think I missed this one. Yeah, supposedly there is another one like that. Okay. So after that, you have the total of current account. Yeah. And this two current account here and this one is basically the result of that and that. Yeah. The difference is between the above and below is that you will break down current accounts calculation inside SOFP. Yeah. Or if you are given with the questions to prepare current account, then you have to do it in the account. Yeah. And then take the balance and then put it in the SOFP. Yeah. Once again, I did not know which one that will be questioned in the IGCSE, but you have to be able to do both. Am I clear? Clear enough, guys? I don't see your face. Why the camera is off, all of you? Ayo, kameranya on dulu ya. Okay, Arfi, thank you for the response. Okay, so that's it. That's the end of this chapter. That's the end of partnership chapter. So the expectations after you learn this is that you are able to do this part, capital part, yeah, capital accounts, current accounts, appropriation. The most common questions of the partnership is appropriation, current account, and how you show capital part in the SOFP. Yeah, it is really, really rare where you have to show all of them Yeah. So once again, either you are required to do extraction for capital account, or you are required to do T accounts of capital and current. But most importantly, in appropriation account are really almost always questioned. Yeah. The remaining questions will be in a form of theory. Why it is better to have partnership compared to sole trader. Yeah. Why it is important to have partnership agreements, those kind of theories. Okay, clear enough, yeah? Okay, let's see. Jump into the question. So this is the example of the questions, exercise book of partnership. Okay, now look at this question. Mustafa and Salma are partners in wholesale business. Yeah, their financial year ends on 30 April. When they started the business, they drew up a partnership agreement. That is the first thing that you need to know when you read partnership business. Okay, partnership agreement, and then you block it or highlight. This is really important. Yeah, it said interest on capital 5% per annum, interest on drawings 6% per annum. Mustafa entitled to an annual salary of 12,000. Residual profits and losses to be shared in the ratio of 3 compared to 2. The partners provided the following information. At 1 May 2018 indicates it is the opening balance of capital and current account. Look at your current account over here, everyone. Your current account of Mustafa is 3,250 credit. It means positive. While for Salma, 1,920 debit. It means negative. Yeah. So what it has to do with your current account, look at your current account here. It means Salma will have balance PD, the one that with, if any. Meanwhile, Mustafa has balance PD in the credit side. Yeah, Mustafa positive, Salma negative. Yeah, look at this word. Yeah, credit and debit. Next, on 1 February 2019, the partners agreed that Mustafa's salary should be increased to 15,000 per annum. Now this one is escalating in terms of difficulties. Which this one? Read very carefully, yeah? 1 February 2019. Now look at this one. Mustafa previously have a salary entitled with a salary of 12,000 per annum. But on 1 February 2019, yeah, the amount of salary has changed. So it means this 12,000 per annum will not going to be received by Mustafa entirely. Think about that. Yeah, think about that. So 12,000 is for 1 year. Yeah, but 1 February 2019, it changed to 15,000. So how should we calculate salaries of Mustafa? Look at this one. Mustafa salary. Pay attention, yeah. In partnership, there will be one tricky questions like that. So you have to be careful. Either it is in the salary or it is in the capital. Yeah, it always been between that two. So salary between 1 May 2018 until before 1 February is 31 January 2019. How many months is that? May, June, July, August, September, October, November, January. 8 months. So Mustafa will receive 8 months out of 12 months times with 12,000. Okay, and then from 1 February 2019 until our accounting period ended on 30 April 2019. So until 30 April 2019, February, March, April, 3 months only. 3 over 12 times with 15,000. Now that's how you calculate total salary of Mustafa. This is the tricky one, yeah? So it is not 12,000 plus 15,000, yeah? Remember. Okay, clear enough, yeah? Next. For the year ended 30, jam berapa nih udah? Oh. For the year ended 30 April 2019, there is informations of drawings. Drawings. The blue one, the one with blue, it means that that is a tricky one, yeah? You have to be careful for that. The one with red, it's a normal information. This is drawings information for Mustafa and Salma. Why do you need drawings information? Because you have to calculate interest on drawings, yeah? And then last one, you have profit. This profit will be needed when you are preparing appropriation account, okay? So, suggest one reason why interest on capital was included in the partnership agreement. You can say that interest on capital, what is that and why it is needed in the partnership agreement, yeah? It is to show how much the reward, yeah, given by partnership to the partners for the investment that is made by the partners, yeah? Suggest one reason why interest on drawings was included in the partnership agreement. You can explain what it is interest on drawings also, just like how I explained in the interest on capital. And then suggest one reason why salary of Mustafa was included in the partnership agreement. So basically, this kind of theory that might occur in the partnership. Yeah, it is not hard. It's just common sense, but you have to state it, write it clearly. Yeah. Now, when you do appropriation account, we will start with net profit. Just follow this one, yeah, guys. Just follow this one. You have net profit. And then after that, followed with interest on drawings. You have the profit already. You have interest on drawings, 6% times 10,000 for Mustafa, 6% times 8,000 for Salma. After that, interest on capital is 5% from the capital account. You have capital account of Mustafa and 5% from Salma. Yeah. And then salary. Now, when you do salary, the salary is only for Mustafa. So there will be no partner B, only partner A, which is Mustafa. And workings for Mustafa's salary is this one. Yeah, is this one. Okay, so find the total amount and then you put that in here. Salaries for Mustafa. Yeah, and place it here. And then after that, profit to be shared is known. Yeah, can be calculated. And then profit shares is in the ratio of 3 compared to 2. 3 compared to 2, it means 3 over 5 versus 2 over 5. Why is it over 5? Because 3 plus 2 equals to 5. Yeah, so for Mustafa, 3 over 5 times whatever you have here. And for Salma, 2 over 5 of whatever you have here. Okay. After that, then prepare Mustafa's current account. Only Mustafa, yeah? Only Mustafa current account. So take all informations of Mustafa. First, we have current account of Mustafa, this one. And then we have drawings, yeah. And then we have salaries. And then we have profit shares taken from here. Yeah, the point is follow this one. You have balance BD, you have interest on capital already in the appropriation. We have salaries partner, we have profit shares. We don't have interest on loan, so you can ignore this. We don't have balance CD, if any, you can ignore this. We have drawings, we don't have balance BD, if any, you can ignore this. We don't have loss shares. If we have profit, then we don't have loss, yeah? And we have interest on drawings. So calculate balance CD, and then that's it, yeah? That's it. Done. Okay. Do you have any question?